Welcome to the Financial Dads Podcast with Paul Fagan and Jody Fisher. This is the podcast for all dads who want to succeed with life's topics, especially related to family and finances. Now here's my dad, Paul Fagan.
Hey Jody, how you doing today?
Hello, Paul. How are you?
I'm doing fantastic. Today we have a very special guest joining us. We have Will Powell, mortgage loan officer at Xceed Financial Credit Union. On a personal note, I've worked with Will since, when did we meet, Will? 14?
14, 15 years old, 84, 85.
That's
Probably
right.
more 85 than 84. Yeah, 85, I think.
And we worked together at an amusement park at Rye Playland in New York, you said, at about 15. And most importantly, Will, you're a dad with a beautiful family.
Yes, I am.
And so how are you doing today, Will?
I am doing very good. Been working from home. I guess this will be, Monday will be my 11th week working from home.
Yeah, I think we're all in the same boat here. Jody, yourself too, right? I think we started around the same time working from home.
Yeah, absolutely. Our school district here on Long Island closed down Friday, March 13th. So that following week was week one that we were all home together.
Yeah.
Yeah.
It's been crazy. So Will, can you give us a little bit of background on yourself before we jump into the news stories and the topics?
I have a degree in business finance, graduated from college in I graduated in 92. I did one semester of grad school, and then I started my first job with Wells Fargo in 93. And I've been in the mortgage business ever since. 10 of the years, so I've been in the mortgage business since 93. 10 of the years, I owned my own mortgage company, which was Mount Vernon Mortgage Resource Center. And that shut down around the last recession. I think I made it to about 2011. So from 2001 to 2011, I was self-employed in the mortgage business. And then I jumped back. And then after that, because I lost so much money when I had to shut down my business, I didn't even want to do it anymore. But I ended up going back. I went to Chase for a while. And now I've been over at Xceed Financial, which is a credit union, for the past 5 years.
Very cool. Very cool. And more importantly, how about your family? I know you have a number of kids. Yeah,
I have 4 children. My oldest son, 25, Josh Powell, he's a U of R, University of Rochester police officer.
Very cool.
My other son, Bryce, he's 20, and he's also going into law enforcement. He's next month, in the month of June, next week is June anyway, he'll be doing the physical fitness piece for the Monroe County Sheriff's Department. Who else? Haley graduates from high school next month, and then Cheney will be going into the 9th grade.
Wow. Very cool.
2 boys, 2 girls.
That is so awesome. I thought I was busy.
You are a busy man. Will, you are a busy man.
Well, you know what? It's a lot easier now compared to 10 years ago, because, we live in Rochester, and we've been in Rochester since 96. And at that time, we didn't have any family up here. So when you have 2, 3, 4 kids and you can't rely on mom and dad for help as far as watching the kids, or have a group of friends and family around you, there were a lot of challenges. But I mean, now with the kids being older, it's a lot easier now.
That's great. Yeah, I feel lazy with I only have my 2 kids. Is it really double the work, Will? I got to ask.
What was that?
Is it really double the work? With 4?
You know what? This is all I know. I can tell you this, which is way different. My experience with childcare for which is way different than most people. We paid for childcare for 18 years.
Wow.
Because every time one child was right about the time when they began school, we had another child. You know what I'm saying? So once you're done with one, we picked up on another, and then you have before and after care for the other 2. So for 18 years, we paid for daycare.
That's like a house.
That hurts. Yeah. Oh man, Will, and I thought ours was long with 2 kids. Woo, that's a long time.
Wow.
Yeah.
Wow. That is very cool, Will. Yeah, we appreciate the background. And before we jump into the topic today, which, by the way, I failed to mention at the top of the podcast, we're going to go through Reddit Personal Finance Random Topics Q&A with Will Powell. We've done this before, Will, and we pick a few topics on Reddit. which is the popular question and answer opinion site, and they have all kinds of different channels, and we focus on the personal finance channels, and we just have fun with it, right? We like to read the random posts, and we kind of move along and look at the URLs and look at the background and kind of have an open discussion about them. But before we jump into the Reddit stories, let's jump into some of the news stories we saw this past week. So the first story is from The Motley Fool, and it's Pandemic Personal Finances, 4 Steps to Take Now. And basically they talk about 4 areas. Review your fee structures, check your asset allocation, combine old 401ks, and inventory high-rate debts. I thought this was interesting. This is more of a investor-type story, but for me, it makes sense. But I'm not sure what you would do in terms of fee structures at this point. But I could agree with the asset allocation. You could talk to your advisor or do your own research to mix the investments around in your retirement funds. But Will, I'll ask you first. What did you think of this story?
Me personally, I would not change anything with my 401k right now. I know that the stock market dropped back in March, but it came roaring back in April and May. I would not touch it. So did you lose some money? Probably, yes. Will that money come back? Yes. Now, if it was like a 6-month loss, or if the market was down for 6 months or so, I can see making some changes. But right now, I wouldn't change any asset allocations right now. In regard to if you inventory your high rate debts, one thing that I'm doing a lot of right now, we're doing a lot of cash out refinances. With the interest rates being, you could get a mortgage now, even on a 30-year term, at 3%. So we have a bunch of people refinancing to consolidate that credit card debt. So that's a great way to get from under those, because most credit cards, even though they're paying next to nothing for their money, they're still going to charge you 15-20%, on your credit card balances. So if you can do it, if you have the equity available in your home, doing a cash out refinance may be an excellent way to not only consolidate that debt, but a lot of times you can consolidate that debt and shorten the term on your mortgage with the money that you're saving from, since you're not paying the credit card.
Very cool. Very cool. And Jody, what did you think of this story this week?
Yeah, I think this is a good article, and I think the main theme that I see here is tracking and eliminating unnecessary expenses. It's never the big nut every month that kills you, right? It's the $15 and the $20 and the $30, and 10 or 12 or 15 of those every month adds up. So you got to track and eliminate those unnecessary expenses. And like Will said, this period that we're in right now with coronavirus and the lockdown and the financial struggles that a lot of people are going through, it's a very good time, and we've said this, Paul, for the last several weeks. It's a very good time, if you do not have a written budget, to get yourself a written budget, get on top of all those expenses, and start eliminating ones that are not necessary.
Yeah, that makes a lot of sense. I mean, I think we're all guilty of having some of those expenses that just kind of linger. Subscriptions we don't need anymore, services we're not using. So that's a good review to take to heart. The second story that we're going to focus on is from the Business Insider. I'm a financial planner, and I find people always forget to save money for the same 3 things. And you know something, Jody and Will, I read this and I said, man, this guy's right. That was my reaction. Midterm goals. So we always think about down the road, 20, 30 years out. But what about 10 years out, 5 years out? The second thing was everything you have to buy after you buy a new house. Man, I remember that very well. And then known expenses with irregular due dates. For example, I have the home insurance that hits a credit card to make sure it gets paid, and I'm always like surprised when it hits. Like I'm like, why did my credit card? Why? Hun, what did you spend on? And then I go look at the credit card, and it's like, oh, that's right. That's the home insurance, right? That's why it ballooned out this month. So I thought this was a good story. Will, what did you think of this story?
Doing midterm goals is something I could definitely do a better job at. I mean, we were planning for years to become seasonal members at a campsite, and we just did it this year, and now we have a bunch of money flowing out. So, but if we, so we planned to do the seasonal, to become seasonal members, but we weren't thinking about all of the other items that we would have to pay for after that. So it is similar to buying a house, because now, you got to buy a lawnmower and a trimmer, and you may want to redecorate. So I think there's a lot of value in this article, and there are definitely things I can do better by reading up on it.
Oh, that's cool. That's cool. And Jody, what did you think of this article? What did you take away?
Yeah, again, I think the need for clear budgeting is apparent here, like we've all said. And also, I like they get into this here, talking when they get into irregular due dates and expenses. Breaking larger pieces of debt or breaking larger payments into smaller bite-sized ones. And I do this with our mortgage, and I think everybody should. And I also do it with some other large expenses, right down to like the car payment and the Verizon bill, which frankly is a pretty large bill every
The
month.
Verizon bill is like a car
put it all
payment these
together.
days.
Oh my gosh.
It
And
is.
we just got, because of all the, this is sidebar here, but we just got the kids phones so they could FaceTime with their friends because they can't get together and they can't be together. So, we went in on the latest iPhone, which is sort of like the bargain iPhone. That can basically do everything. So they can at least see their friends and talk with their friends, and they can text. But now we've got like 4 phones in the house. The Verizon bill has ballooned.
Please hang up and try again.
Yeah, so you got to cut that bill into smaller bite-sized pieces. And what I've done with the mortgage is actually broken it down into a bi-weekly payment that I set aside into a savings account and then draw down on that savings account when the bill comes due. I've broken it into 25 payments over the course of the year. But if you break it down into a monthly expense, you end up with those months that are 3 paycheck, if you get paid biweekly, those 3 paycheck months that happen like once or twice a year, and that can be automatic savings for you.
Yes,
so breaking those larger payments into smaller ones that they kind of talk about here in this article, I think is really smart.
Oh, that's very cool. Yeah, I think overall, I really did that. All 3 things jumped out at me, and I said, "Man, this person was completely right in terms of I missed all 3 of those, and I'm not good at any of those, right? So I'm always surprised that all those pieces kind of resonated with me well. So I think with that, we'll jump into our weekly topic, Reddit personal finance random topics. Right? So the first one that we're going to review is an interesting one, and the headline is, "My mom has over $20,000 in credit card debt. She is considering withdrawing from her 401k since penalties have been waived to pay it off. Is this a good idea?" Maybe, well, I'll give a little bit more of a description here. It says, "Long story short, my single mom had stage 3 colon cancer and was out of work for a decent amount of time and accrued a lot of credit card debt in 2 years. She is a nurse, so she has a stable job at this time. Since they've waived the penalty to withdraw 401k through the CARES Act, she's considering withdrawing enough to pay off the credit card debt. So as long as you pay it back in 3 years, you could do it tax-free. So is this a good idea?" So Jody, what were your thoughts on this when you read this?
Yeah, well, number one, thank you to this person for the work that she does as a nurse. We're very sorry to hear about her diagnosis, but also glad that it sounds at least like she's doing better. Saying they have a stable job, great. I like the phrase "at this time" because no job is ever stable permanently, right? I've been there. I've been fired a couple times. I've been caught off guard a couple times, and so you're never completely safe. So I always couch my approach to this type of a question with that. Withdrawing 401k money. Generally a bad idea because of the penalty that's associated with it. That said, I have done it myself. You really want to make sure you know what you're getting into. If you're gonna pay a penalty, now if you know you're gonna pay the penalty and you're okay with paying the penalty, that's fine. They talk about paying this back here. I would say that if you're going to do this, make sure that payback has got a solid plan behind it. Don't just say, "Yeah, I'll pay it back in 3 years." That's a promise. That's not a plan. So you need to make sure that you've got a plan to pay this back so you don't get double tagged on this withdrawal. That's the advice that I would give.
Yeah, I'm looking at the story, and I guess it's hard to read. I think they're actually talking about a withdrawal and not a loan. So they're actually talking about taking the money out permanently, which of course has other ramifications. So Jody, I agree with you. Maybe it's probably better to take a loan against the 401k rather than withdrawing, because then even though it's penalty free, I think you still have to worry about the taxes, and there's lots to kind of think about in terms of if you lose your job and you have to pay, you have to pay that 401k back, the loan back immediately. I think there's like a 90-day period. There's a lot of little gotchas that could be involved with either loans or withdrawals, so you have to read the fine print closely. Well, what was your thought when you read this story?
My thought is if she's pulling out 20 grand and she's not doing it as a loan, she's not going to pay it back. If she plans to pay it back, she needs to do a 3-year loan through her 401k account so that she can be accountable to herself. It's hard to hold yourself accountable unless you're forced to do it. If she does it as a loan, where the monthly payment, like it would be a car payment, $250, payroll deducted out of her paycheck every month, it's going to happen. If she has to do it on her own, it's not going to happen. And then, like you said, if she loses her job, it becomes a taxable event, and things just get worse. So hopefully someone can guide her in the direction as doing it as a 3 or 5 year loan versus just pulling the money out without being accountable to herself as far as how she plans to put the money back in. Because we all know, you get your paycheck, you get that one car repair bill, you were planning on putting that $300 away to go towards the loan. It's not going to happen.
Yeah, I'd have to agree, and I think, Jody, you're on the same page as well. I'd rather see this as a loan rather than a withdrawal. Besides the financial perils, as Will said, there's all these psychological ones, right? Because you're right, you're never going to pay it back if you don't have to, right? You have to be forced into kind of doing it. So I think that makes sense. The second topic is tips on saving as a university student. I'm a 20-year-old university student and will be for the next 4 years at least. What tips do you have on early good money practices such as saving, investing, spending? Since I have a very small income at the moment and I'm working part-time in my spare time only, making about 2.5 pounds per year. So I guess this one is out of London. Lots of commentary here. Jody, what was your thought when it came to this story?
My first thought was, boy, I wish I was this person, 20 years old and a good, I'm about to be 50, so 30 years of income and investing opportunity in front of me. My advice to this person would be get yourself a written financial plan and stick to it. You have no idea how wealthy you can be in the next 10 or 20 or 30 years if you just start saving money now and don't blow it on things that you don't need.
Very cool. Very cool. And Will, what was your take on this story?
My take on this story, the advice I would give this young guy, I would tell him he doesn't make a lot of money. He should have, and this is what I did with my sons when they were, I did it with my daughter too when she was working at JCPenney. He needs to set it up where he has an automatic deposit going into a savings account. I wouldn't focus on investing. I would focus more on savings. Because if you can become a saver, and that's one of the biggest challenges for most young kids, if you can get used to saving 20% of your weekly pay or biweekly pay, have it go into a separate savings account to put yourself in a position where you can pay an unexpected expense without needing a credit card. That's how you really come into your own as once you begin to earn more money and do more things with the money. So I would tell him have an automatic setup where he has 10 or 20% of whatever his weekly or whatever his weekly gross or net pay is go into a savings account for savings. Now, I wouldn't worry about investing at 20 years old and being in college. More about just having some money put aside just in case you need it so that you won't use the credit cards, because I know for a fact most college students use credit cards because they don't have any money or they don't have enough money to buy the things that they want. But if you have a job and you're willing to put away some money, do that. That would be my advice for them.
Yeah, that's well put. And I think for me, the thing that jumped out was, and I talked about this, I think we did almost a whole podcast on this, right, Jody, is pay yourself first. Get into that mantra early. And if you listen to the last episode, or I think it's the number 50, if you listen to episode number 50, I kind of give the ending to that story in terms of why it meant so much to me. So I'll leave that out there as a teaser. The other thing that jumped out at me was, the concept of automatic, right? This automatic payment to yourself or to the savings, to make sure, kind of set it and forget it, like that Ronco roaster, right? The rotisserie roaster, set it and forget it.
No temperature settings. You just put the food in, set the timer, set it, and you got it, guys.
And I think
Still
David,
have it.
do you have
Deep
one?
cuts, baby.
That's
Deep
awesome.
cuts.
And I have, I think David Bach talks about the whole automatic. Everything is on an automatic payment schedule. So, whether it's your mortgage payment, whether it's credit card, whatever it is, right? Get into the idea of making it automatic. I have to admit, I don't do too much of that. I do some of that, but not all of it. I still like to kind of figure out where the money's going. So there are some things that I let automatically pay. Usually it's tied to a credit card. And then the other bills, because I like to see where the money's going. And maybe that's just personal preference. But I think there's nothing wrong with set it and forget it. If that's the way you conduct your personal finance rituals, I think that's the way to go.
Absolutely.
Very cool. Very cool. So the next story we're going to go to, number 3, is the pay down mortgage then refi, or refi and put as down payment. Doesn't matter. We owe $150,000 on our mortgage, have IR of 4.2% currently, 3 years into a 30-year fixed. We'll be using $70,000 to $80,000 to pay down and refi. Possible rates right now are at 2.7% on a 15-year fixed with a different bank. Does it matter if we pay down the current mortgage then refi with no minimal money down, I should say? Or should I just go to the new financial institution, apply to put the $70,000 to $80,000 as a down payment? Will going either route affect anything monetarily in the short or long run? I probably should have read this first and then read it, because I did butcher that a bit, but you could read it on the Facebook page or go to Reddit and look at this question. But Will, I have to leave this one to you as the mortgage guru. So what are your thoughts when you saw this question?
You know what? From a processing standpoint, I would tell them to pay down the mortgage first, and I'll tell you why. Because if they refinance and say, I want to bring $70,000 or $80,000 to the table, we're going to have to source and season that, and we don't know where the money's coming from. If it's a gift, if you're pulling it out of your 401k, if it's savings. And so that's just one more thing to worry about. So if they could pay it down first, you make that large payment to your mortgage, and then you refinance it. I mean, because either way, you're going to get the same result. But from my perspective, being in the business, I would say pay down your mortgage and then refinance it.
Okay, cool. And Jody, what were your thoughts when you saw this question?
Well, that is a super smart detail that I didn't even think of until you actually said it, and now I'm recalling being in that same situation, and that's what I'll say naive or inexperienced mortgage borrowers who don't have a good advisor like you are will get themselves into. It's all the paperwork and all the hassle of taking out a mortgage, right? And all the stuff that's just baked into the process that frankly even the bank maybe not even, or the lender might not even be necessarily in charge of, right? They just have to execute all of this stuff. It can be a real pain in the butt to do all this stuff. So that is a really smart observation about paying. If they want to do this way, pay it down first and then go and borrow on the reduced balance, and sort of easing out their process and simplifying their life. My only thought here was, and Will, you give me your opinion here. If I was in this borrower's shoes, choosing between a 15 and a 30, if the rate was the same or virtually the same, I would always opt for the 30-year and then pay it like a 15, because what that would do over the long term, it would give me the flexibility if I ran into a problem to actually be able to make a smaller payment and sort of ease up my financial situation if I had a job loss or if something else came along where I needed to pull back money from somewhere. I could pull it back from that mortgage payment without having to go through the hassle of talking to the lender and saying, hey, I need to reduce my mortgage payment. I could just pull it back. So Will, give me your advice. I mean, is
Well,
taking the 30 and paying it like a 15 smart?
Well, it comes down to financial discipline. And the reason I would not take the 30 is for two reasons. The interest rate you're going to get on 30 is going to be higher than the rate that you're going to get on a 15-year term. Secondly, with them laying down $70,000 to $80,000, as long as their current payment is affordable for them, if their current payment is affordable and they put down $80,000 and refinance into a 15-year term, their payment may be the same, if not lower, than what they're paying right now. Now, if they need payment relief, that's one thing. You got to go with the 30, and then you're going to be paying less than what you were paying before. But if you were comfortable with that mortgage payment, you got to go with the 15. And I'll tell you, because and sometimes I have to talk people. I talk people into it sometimes, and I talk people out of it depending on their circumstances. Most people do not have that financial discipline. Most people, when you see that extra $300 or $400 around the house, you're not going to always lay it down on the mortgage. You're going to want to go buy that big screen TV. You're going to want to replace the lawnmower. You see what I'm saying? Something always pops up. But the first question is, are you comfortable with your mortgage payment? If you are, take the lower rate, take the 15-year term.
Very well.
Smart.
Yeah.
Smart stuff. Yeah.
Yeah, I feel like we could do a whole podcast just with Will on mortgages, right? We have a wealth of knowledge when you've seen it all in terms of mortgages, right? In terms of
I've seen it.
which is great. So this is all good stuff. I know for me personally, when I flipped from a 30 to a 15, I agree with Jody in some respects, but I also agree with you, Will, in terms of human nature. I might have gotten financially lazy and started paying my 30 like a 30. And when I had the 15, I had to pay it.
I think the difference in this situation is the fact that they have $80,000 to lay down.
Yeah, what is that all about?
Yeah, if you have that kind of money to put down, you got to go with the 15. Because if you lay down $80,000 and you stay on the 30, you're going to probably save about $500 a month. Now, if you need to reduce your payment, I get it. That's, stay with the 30. But if your mortgage payment is comfortable and you're able to save money and do all the other things that you need to do, you got to go with the 15. Because most people, let's say, for example, even in your situation, Paul, most people, if the rates drop down by at least 2 percentage points, let's say, for example, if your rate was 5 and you can get a 3% rate on a 15-year term, a lot of times going from the 30 to the 15, if you've been in that mortgage for 5 or 6 years, you can get into that 15-year product and keep your payment relatively the same. Putting an extra $80,000 down on the mortgage is the game changer. Do you see what I'm saying? That could actually they may actually go down to a 15-year term and pay less money because they made such a large down payment. Or actually, they will pay less money because they only owe $150,000 on the property. They're paying half the balance down. So if you go from 150 down to 80, you're gonna save a ton of money interest-wise, and your payment's gonna go way down. So it's not like they owed $500,000 and they put down an $80,000 payment. They owed $150,000 and they're putting an $80,000 down payment.
That makes a lot of sense.
This is why you need Will. That's also smart. And this is why people who are borrowing on a mortgage, whether they're first time or whether they're refining or whatever, they need someone like Will who can walk them through these different scenarios, and walk them through. We've said this too, Paul. Without judgment. Will, I can hear what you're saying. You're not telling people what to do. You're saying if you go this way, you're going to get this. If you go that way, you're going to get that. And now you guys consider what's good for you. It's so smart, Will.
Yeah, that's like Dave Ramsey says, right? The heart of a teacher, right? And I think, Will, you've listened to Dave as well, and that's how
I taught his class.
Wow. Wow. And Jody, that's how Jody and I started talking about this. And so Dave Ramsey was the thread. So that's interesting. So you were able, I know we're going off topic, but you taught his class? Tell us a little bit about that.
What was that?
Can you tell us a little bit about that?
Oh, absolutely. Well, see, it was a church group that I was a part of. This is like 8 or 10 years ago. And we had a church member who had taken the class, and then we found out that that you could do it in a group setting where they give you the teacher's handbook, and they give you stuff to put on the big screen, and so I would stand up in front. We would do our rah-rah session, and then the first step is putting your first $1,000 together. So for a lot of people, how do I come up with that first $1,000? And so we would follow up and encourage people on a week-to-week basis to see how they were coming along with getting that first $1,000, and then from there, focusing on paying the lowest balance, the credit card with the lowest balance first, paying that off, and then doing the snowball effect, and I still use a lot of this stuff. Using, after you pay off that first credit card, that $50 a month, you put it on the next credit card, and then you work each credit card until you pay all of your credit cards off. So, but it was a great experience. What I've learned is by me teaching the class, it made me be more accountable to myself, because I already work in the business. But when I have to go there and I have to be an active participant because I'm teaching you, I can't teach you something that I'm not doing personally.
Wow. Yeah, that makes sense.
You see what I'm saying? Because we each have to pay $100 just to attend it, but you can pay $100 just to attend it and go through the motions. But I had to pay $100 and stand up in front of you and encourage you to follow these steps. And then we would meet up the following week. Hey, and we would go around the room. How'd you do this week? Hey, we were able to put another $250 a week to go towards saving our first $1,000, or we're working on paying off our MasterCard, or we just paid off our car loan and we're going to continue to drive this car instead of going out to buy a new car. So, but it made me more accountable to myself by teaching others the class.
Well, thanks for that insight, because I've never attended a class, and I've taken stuff off his website. I've read a couple of his books. I used to listen to his podcast a lot, and that kind of, I think, probably unintentionally or subconsciously inspired us, Jody, right, to create this podcast, right? So that's great insight, because I always thought that I would love to take his class, but I was kind of self-taught when it came to the Dave Ramsey methodology. Jody, any words on Dave Ramsey?
Yeah, I think what Will said was great there, and what especially hit home with me was walking the walk, right? Will, you talk about standing up in front of a group of people, and you're teaching them something. If you're not walking that same road yourself, you're not teaching it right, and you don't believe in it, and you turn into a huckster, right? And right. So I think that was a great story. I loved hearing it. And it sounds like you also have we just met here on the podcast, but it sounds like you have a ton of integrity.
Thank you.
Very cool. Very cool. The next topic we'll jump into is the question is: new grad who just started working, balancing 401k contributions and paying off student loans. So I guess here they're going into a lot of detail on, well, if I put this into the 401k, I get the match, but that I have this big student loan I need to pay off. So I'm not going to go into the whole story. You could read it on the site, but I think it's that age-old dilemma. Do I invest? Do I pay off my student loan? Jody, what did you think of this question?
Well, my first reaction was that he's got a lot going on here, and it sounds like he's really overcomplicating things for himself. And there's a lot of detail in this story about, he says he's got about $1,500 in savings. Company doesn't have a 401k match, but it contributes $500 annually towards an HSA, health savings account, I'm assuming.
Right.
And so that's money that you spend on your health care. It's not necessarily savings. Granted, it's money that you don't have to take out of your weekly paycheck to pay for stuff, and we have that, and everybody has that in their household. But that's something a little different than savings. It's more like saving towards an expense, tax-free. So a lot of complicated things going on. The one thing that I pulled out immediately from the way this guy presented his situation is never trust your company won't change its course. Just because things are going great now if you're an employee, just because things are going great for your company right now doesn't mean that things might start not going great for them, and they might have to change things. Don't put complete trust in that company. Put complete trust in yourself, right? Protect yourself. $1,500 in savings, a great start. Pile that cash up, I think, as high as it can go. And if you've got $5,000 in debt, man, that should get paid off in 6 months. I mean, if you're 22 years old and single, and you're making $80,000 a year, man, take it down. Talk about Dave Ramsey-isms. Take it down to beans and rice, and get rid of that $5,000 debt like that. If that $5,000 will hang around, if you just play with it, get it gone, and then start savings. You can't do both at the same time.
Yep, sounds good. And Will, what was your thought when it came to this question?
You know what? I agree. You got to pay that debt off, because you know what? When you're in debt, it's like you're a slave to the owner of that debt. So if you can pay that debt off, you'll have more money to invest once you're free of the debt. So focus on the debt. You make a decent amount of money. You could, like you said, you could pay it off in 6 months, and then you could do whatever the next thing is for you investment wise.
Yeah, that makes a lot of sense. What both of you said makes a lot of sense. So we've talked about this a lot on the podcast around debt, right? And we're big fans of getting debt out of your life if you can, as fast as you can.
If you need a convincer too on the pay down the debt, pick up your paper credit card statement and search on the credit card statement. Somewhere there's this little graph that says if you pay the monthly payment, you'll pay it off in this amount of time.
It's going to take you to pay it off. Oh, absolutely.
Right? It'll actually show you how long and how long it's going to take you to pay it off, and that number should shock the shorts out of you, man. You should fall out of your chair when you see that, because it's going to be like 8 years. Right? It's not going to be 3 months. It's going to be like 8 years. They might even have a year on there. It'll look like 2032. Get it out. Get it done.
I can't get past 2032. Got to pay for that steak dinner.
Right? That steak dinner, right? Or that big screen TV you bought is going to take you 12 years to pay it off. Ridiculous.
It'll be in the dumpster by the time before you even get a chance to pay it off. That's amazing. Yeah, I think that overall, when it came to, we want to get rid of debt, and I think that's the bottom line. I think we all agree that, we want to try to get rid of it as fast as possible to get it out of our lives so we can move on to bigger and better things in terms of savings and other goals. So I fully agree with everything you guys said. The last question that we're going to talk about today is, should I even get life insurance? I don't know if this is discussed much, but I need help. My mom is constantly on me, telling me to get life insurance for my husband and child. I'm going to stop right there, right? Because we did a whole episode on this, and we talk about term life versus whole life. And I'll just kind of start this dialogue off. In that episode, I emphasized, I think right before my son was born or right after my son was born, I went and got the life insurance. And I was sold a hybrid policy of whole life term or term whole life. It was very hokey. And then over time, I was able to renew that, actually cancel that policy and get a term life policy that made sense for me. So I think the bottom line, I just stop reading that posting, because if I see husband, child, if you have dependents that rely on you, you need life insurance. So Jody, I'll pass it to you. What would you think of this question?
Life insurance is, like you said, Paul, it replaces your earnings and protects those you leave behind when you die. And, put a fine point on it. We are all going to die someday. You got to ask yourself the question, what happens when you die? And then what happens to the people who you leave behind? Will they be at a loss without the money, without the salary, without the income you generate. So if you need to replace that for those people you're going to leave behind, you need life insurance. And just a note on the child, I'm going to make an assumption here that the child is under 18 and not making any money. Generally, I feel that you don't need life insurance on a child because you're not replacing any income, because the child doesn't generate any income. If the child is older, maybe you want to take something to take care of them if you have a specific situation. But if the child is older than 18, they should be making their own money anyway.
That makes a lot of sense. And Will, what were your thoughts when it came to this question?
My thoughts is they should definitely have life insurance. Term life insurance is very affordable. Most people, and I know, Paul, you were talking about, you have the hybrid whole life term policy, but most people, even though insurance agents will try to push you into a whole life insurance policy because of the cash value, most people who have a family, it's not affordable where you're paying $300, $400, $500 a month plus everything else that you're doing. But term insurance, especially when you're younger, like at our age, you could probably get a $500,000 policy if you're healthy for maybe $40 a month. $40 a month for a $500,000 policy. Or you can scale it back to your earnings level. If you're only making $50,000 a year, maybe you should get a $100,000 policy. $100,000 policy may cost you $15 a month, but no matter how you slice it, it's very affordable. And it's not like you would have to give anything up in order to get the benefit of that policy. So yes, they should definitely have life insurance. And there's so many different price points, even if it's just 50,000. You know what I'm saying? You should do something that's affordable for you, but there's so many different ways you can buy life insurance and so many different price points. You can't lose by having it.
Yep, that makes a lot of sense. And we did a whole podcast talking about life insurance, term life versus whole, and we went into detail on these. So I think with that, the bottom line is, and we all agree, if you have people that depend upon you, make sure you get that life insurance in place. So I guess with that, those are all the topics we were covering today. And this was a lot of fun, Will. Thank you for joining us. We really appreciate it.
Guys. Thank you for plugging me in. I appreciate it.
Yeah, this was very cool, and I'm going to put you on the spot. I'm hoping we could do this again with you. There's a number of topics that kept blazing through my mind. Mortgages
because it's camping season. We have a permanent site, so we're going to be heading out there after this. I got to do some work on the camper, and we're excited about that. And I have to build a few things. We're going to build some stubs and a picnic table. So, but I would love to plug in with you guys and talk about my areas of expertise. Because sometimes I feel that I don't get a chance to share this information enough. I feel I should be on the radio. I thought that a long time ago. So if this is as close as I can get to it, let's do it.
Oh, awesome. That's very cool. So Jody, any last words of advice for today?
Two things. One, we are definitely having Will back on the show.
Absolutely.
Because he's got a ton that he can share.
A lot of light bulb moments.
And number two, Will, I am hearing power tools in your immediate future there. I want to come over.
You know what? Let me tell you what's funny. I can do more things now than I could 10 years ago. I'm not the best at it. It may take me a little bit longer, but my wife pushes me into learning how to use the tools. So I got a lot of power tools now. We built last Saturday, we bought a shed to put up behind the camper, and we had to build the freaking foundation. What do I know? I'm a city kid. What do I know about building a freaking foundation? But we figured it out. I had all the right tools for the job, and I enjoy using my tools. So we built the foundation. My sons came by. They helped us put the shed up. So it was great. And so, from time to time, we work on different projects. We built her a desk for her office. I just built her some cabinets a couple of weeks ago. And we're going to build some more stuff for the campers. So I do get to use my power. Let me tell you, because I also enjoy cigar smoking. And so I smoke cigars in my garage, like in the wintertime. And I have a heater. I can get my garage up to like 80 degrees when it's like 25 degrees outside. So I enjoy watching television, smoking my cigar, and looking at my tools on a Friday. That's my life. That's what I do. Smoke cigars, watch a show, and just say, wow, I got some cool tools. That's what I do.
Will, where you been all my life?
Oh, well, that's awesome. That's awesome. Well, Jody and Will, I thoroughly enjoyed our discussion today, and I'm personally looking forward to the next one. Thanks, everyone, for downloading our podcast. If you have any questions or comments, please email us at financialdads@gmail.com or check us out on Facebook. Just go to financialdads.com. So with that, this is Paul and Jody and Will reminding you managing finances can be stressful, but that's why the Financial Dads are here to help you plan for success. Have a good one, everybody. Be well, and thank you.